This is Mike Hogan with Stewart-Peterson Incorporated's advisory team. We believe there are three key things that dairy producers need to know. Our fundamental discussion starts on milk production, where we've been essentially in an increasing environment ever since the 2012 drought. We had a few blips between February and March this year, but we've been in a steady increase ever since, most notably between July and August, where we've seen a 2.6% increase, which is the best gain we've seen in over a decade. That may paint a bit of a bearish picture as you look at milk prices. When we look at dairy cow slaughter, this is also giving us an indication as to the number of cows on farm. When we look at the graphs going from my lower left to my upper right, these are cumulative graphs showing you the amount of dairy cows that are slaughtered each of the last 3 years. When we look at the graph on the upper left to the lower right, or the yellow line, that's showing our year-over-year change. We're seeing one of the smallest year-over-year changes currently. We're currently sitting at about 2% after being at a high of 12% back in January. To give you an idea of how this is different than years in the past, between 2011 and 2012, our increase was 6% year-over-year. When we turn away from the production and the cow numbers and we look at some of the product numbers, we're also seeing some bearish figures, especially in our stocks element. Cheese, for example, we've made record storage stocks in place at this time. We have seen a bit of a seasonal pullback, but do note that seasonal pullback is still above the highs from both 2011 and 2012. So again, these are all things that are in essence weighing on the market from the supply side. It is a bit of a different story as we turn the corner towards the demand side trends that we're seeing. Every discussion in dairy on the demand side has to start with the exports. It's talked about in coffee shops all across the country. Most notably, you saw the products at over 200,000 metric tons exported during the month of May. We've held pretty steady in the months that have followed. Just a tremendous summer selling season for our exports. When we take a slice of those exports out, two notable things that we want to look at in the cheese market. One, we saw almost 28,000 metric tons exported during the month of May, and we're seeing a counter-seasonal spike in exports for cheese right now. Usually during this time of year we're declining quite steadily. That is not the case looking forward. And we can see why in this graph. This is the Global Dairy Trades Trade Weighted Index, and simply stated, it's at a high price point right now. So if we break down some of the components, we can see why we've gained so much export business. For example, cheese in Oceania is around the $2 mark. We're currently around the $1.75 area here in the U.S. We're also seeing a very similar pattern in many of the different dairy product markets as well. So simply stated, high prices elsewhere around the globe are really helping out our lower priced commodities at this time. So when we look at the fundamentals, it truly is a mixed bag. When we see the supply side fundamentals coming to fruition, it is the farmer doing their jobs. We're seeing milk production, cow slaughter, etc., just high and probably bearish elements into the marketplace. On the demand side, it's headlined by exports, and simply stated, they are on fire, and folks are taking our products at a fairly rapid rate at this time. So when we look ahead, we have to look at some of the outside markets to see if they'll give us a better pricing clue. Most notably, we're going to take a look at the U.S. dollar. Right now there's two scenarios playing out in the U.S. dollar, and that's mainly because we have a consolidative pattern taking place right now. One scenario is very bearish, one scenario is very bullish. In front of you right now is that bearish scenario. When we look at cycle patterns and wave theories, when we look at different markets, right now a few of those theories are pointing towards the next leg lower in the U.S. dollar, and that would be very negative towards the dollar impact on price, potentially positive towards dairy prices. The other scenario that's painting out is we could have put in a long-time cyclical low during the 2008 financial crisis. If that's the case, we have a chance for the dollar to move rapidly higher between 95 and say 105. And if that's the case, those would be net affecting the dairy prices towards the negative side of things at this time. So when we look at the dollar, we have one thing to say, and that's something big is coming. Which direction it's coming, that's yet to be determined. But there are a few interesting things as to how the dollar plays into what's happening within the dairy space. This chart, we see the blue line is the U.S. dollar, the black line is cheddar cheese prices, and they are inversely correlated. And what that means is, as the dollar is moving lower, generally speaking, cheddar is going to be moving higher. and vice versa. We can see this throughout this graphic, and currently they are both in very much a sideways consolidative pattern. So it'll be very interesting to see which way the dollar breaks out. That will probably provide some direction towards this cheese market. And remember, markets do not stay in those consolidative patterns forever. They will likely move one direction or another, and with as consolidative as we've been, it's likely going to be a big move. We're seeing some very similar patterns in milk. Right now, it too is in a consolidative pattern. A breakout would prepare us for $22 milk, or a drop all the way to $14 milk, depending on which way the market breaks out. We're seeing the same thing in many of the product markets. We'll highlight whey, for example. Whey has also been in a very consolidative market. A breakout to the upside could be 70, 75 cents. To the downside, below 50 cents is likely, maybe even towards the 40-cent area. And again, consolidative patterns generally do not keep going for forever, so something big is likely to happen. One of the things that producers should likely be looking at is also their feed input costs. This chart exemplifies this between corn and milk prices. What we see on corn is that it moves in conjunction with milk, probably as a leading indicator. And if that's the case, we've seen quite a break in corn recently. We haven't seen the same break in dairy prices, likely because meal prices have stayed relatively steady at this time. But this could be somewhat of a forecast and something that producers definitely need to pay attention to. Now that we've talked about the fundamental impacts that we're seeing, the dollar impacts that could be coming up ahead for the dairy market, what is the dairy producer to do? We believe it's to prepare for multiple possibilities within the market. As we saw, there's a pretty good story to be had for $22 milk. There's also a pretty good story to be had for $14 milk. And both those are definite possibilities as we look at the markets today. And we believe that producers should be prepared for both of those scenarios. Even though it's been in a consolidative pattern, the volatility will continue. And as we say here at the office, there's always a great fundamental story to convince you to do exactly the wrong thing with your dairy prices. With that, this is Mike Hogan with your Stewart-Peterson Incorporated advisory team. Thanking you very much for spending some time with us. Have a great day.